go over this section very quick because we talked about this in Chapter 4. We talked about this again in Chapter 5. So here's because we're reaching equity sections, and this chapter brought up again retained earnings transactions. But really, you already know all these closing entries. And remember, the sequence is we close all the revenues accounts, and then we close expenses accounts, and then we want to determine whether the company has new net income or net loss, and we transfer that information to retained earnings account. So retained earnings really is the account that holds accumulated net income on a yearly basis, because remember, income statement accounts are temporary accounts, so we usually zero them out. Income statement only shows whatever that is accumulated for that year or that season. Later on, we'll just summarize them all together under retained earnings account. So here's an example, just very simple. If we have sales revenue, $500,000, and we want to close it at year end, we would debit sales revenue. Again, if we want to zero out accounts, we would post it under the opposite section, opposite direction. Okay, so sales revenue, the normal balance is the right side. When we close it out, we would debit this account. Now, as for income summary for when we close expenses, it's the opposite. Right? Expenses, normal balance is the debit side. So when we close expenses, we will be crediting expenses. Again, closing accounts, the purpose is to zero out all the temporary accounts. And we transfer everything temporarily to income summary. So you have income summary T account, right-hand side, transferred revenues, left-hand side, transferred expenses. Overall, then you can determine whether or not the company has net income or net loss for that season. So in this case, it's obvious there's $100,000 revenue in excess of expenses. So we have net income $100,000. Okay, first entry, closed sales or service revenue, any type of revenue accounts, or even contra revenue accounts. Okay, second entry, all different types of expenses. Okay, usually we will list them one by one. Right? Here's just an example that we combine them. Usually, because each and every expense, there's a separate T accounts, so we would separate the expenses. You usually have a whole list of cost of goods sold, advertisement expense, operating expenses, so on and so forth. So the third closing entry, basically we want to do something about this and close out the income summary account. Okay, so the third closing entry here, since it's net income, that will increase retained earnings. Third closing entries increases retained earnings. Okay, if you're confused about income summary direction, just think about whether or not net income, whether the company has net income or net loss, and whether that increases or decreases retained earnings. So net income definitely boosts up retained earnings. So if you know retained earnings is on the credit side, then the other side is income summary. So this transaction here immediately closes out income summary. You see retained earnings under right side of, you see net income represented under retained earnings, the right side. Now, in the case that company doesn't have net income generated in this year, then this entry we will flip it. Okay, if it's net loss, that reduces retained earnings. We'll be debiting retained earnings, crediting income summary. Okay, but this is a case of having net income. Now, there's dividends. We would also close out dividends. Remember, but again, company do not necessarily give away dividends. So if there is that account, oftentimes we would also close dividends. Again, dividends reduces retained earnings. So when we close dividends, that would debit retained earnings, credit dividends. Which one? It's on the debit side because earlier we had net income here, and if we want to close out this, then we will be posting it to this side. Okay? And then also retained earnings increases, so retained earnings definitely is on the credit side.